Hi. In this video, I want to talk about the 6 most common mistakes traders make. And if you can eradicate these mistakes from yourself, you will definitely be able to improve your trading performance and make more profits from your trades. So without going on too long, let's start with the first mistake. The first error is called FOMO, fear of missing out. It's the fear of some missed opportunity. How often do you have such a situation when you have a good signal on your strategy, a good entry point, but you don't enter it because you are afraid of something? This is often the case because many traders study the news, study some analytics, look at dozens of different indicators, and sure enough, something will speak against your trade. And when you get into that state, when you see once, second time, third time, that you missed a good trade, you start using signals that are not clear enough, not accurate enough. And once you start getting into those kinds of semi-signals, semi-annual entry points, you're going to start losing a lot of money. Let's look at a concrete example. Here's the chart in front of you. Yes, we can identify a clear support level here, and for most strategies, we would trade from this support upwards. And imagine you are at this point, you see a red candle that reaches the support level. This is where you'll really want to open a new trade up. But let's say some of the elements of your strategy indicate that this is a bad entry point. And as you can see, the chart just continued to fall. It did not bounce off that support level. And you, just because you've already settled for entry points that aren't ready, you've lost money. Therefore, it is very important to always follow the strategy clearly and follow your indicators clearly. If anything, if the deal is not perfect in any way, it is better to skip such a deal. Believe me, you will have enough time, enough trades, you have nowhere to hurry. And what distinguishes a good trader from an excellent one is this patience. Patience, the ability to wait for good entry points. The second very important mistake, it's a very common mistake, is trading on emotion. Remember, fear and greed are the 2 main enemies of a trader. And so, the most important recommendation, in order to avoid big emotions in the rating, do not trade with large amounts. Do not trade with large lots. I recommend putting 2 to 3% risk on each trade. If that's a lot for you too, you can put up 1% risk. But the loss from any one particular trade should not be very tangible for you, should not be very significant. And once you reduce the trade size, you'll see how much easier it is emotionally for you to trade. So the second mistake has been solved. It is to reduce the lot, and you will be able to trade much more profitable. So, moving on to the third mistake. The third and most common mistake is the lack of stop losses. On any chart and on any trade, you should definitely have a point at which you say, okay, this is too much. This is where I would exit the trade. When people trade with no stop loss and open trades with no stop loss, no loss limit, it's often the case that they can catch just a very long candle. Some news will come out, for example, here you were standing in a trade down and some very important news came out and the chart jumped up sharply. If you didn't have a stop loss, you're losing a lot of money. Therefore, it is obligatory to always have a stop loss on every trade. Yes, it will sometimes fail, you will sometimes take losses on them, but it is a natural limiter that will keep you from many losses and from losing money. The fourth common mistake is charts like this. I very often, especially with newbies, see a million indicators on a chart. And I realize that when you go into terminal trading view, there are hundreds of different tools, and you're like a kid in a candy store trying to grab literally everything. But on such charts, when you have 5, 6 indicators installed, you don't see the most important thing. You don't see the chart. It is very important that you see the chart clearly because it gives you much more information than any tool available. And I advise you to choose 1 or 2 instruments in your trading, or to choose some clear, understandable strategy and stick to it all the time without getting distracted by other instruments, news, analytics, and so on. Choose a working instrument with good profitability and follow it only. The next 5th important mistake is not working on the trend. I realize that you often see resistance support levels in chart analysis textbooks. You put them out and trade on the rebound, and you think that here you have caught the perfect high point or the perfect low point. But this is a very dangerous trade. Believe me, catching the perfect high or the perfect low is very difficult. It is unlikely that the chart was growing, and you caught the perfect pivot point, and from it, you will open a trade. More often than not, if a chart has been rising before, it will continue to rise further. Therefore, when you see an uptrend, it is better to open trades only upwards. When you see a losing trend, it is better to open trades only downwards. The easiest tool to help you distinguish an uptrend from a downtrend on a chart is a moving average. You can simply put a regular moving average with a period of 200 on the chart. We change the period to 200, so it will show the average value for 200 candles. And anything above the 200 moving average is an uptrend. And on such areas, it is worth to open deals only upwards. If right now the candles are above the 200 moving average, you only open up trades. If the chart has gone down below the moving average like here, it is a sign of a downtrend, and trades should be opened only downwards. I realize that this is a very simple and banal rule, and you may have heard it many times, but few traders, including experienced ones, actually use it. Therefore, never hesitate to trade in the direction of the trend. When you already have enough experience, you can already try to look for bounces on the chart and other pivot points. And the last, probably the most common mistake, is not having a trading diary, not tracking results. Be sure to have a simple spreadsheet in Excel where you just write down your trades and basic information on them. Asset, time frame, time of expiration of your trade, stop loss, take profit, and other important points that you used to open this trade or close it. And it is very convenient to summarize each deal in percentages and mark each deal green if it is positive and red if it is negative. In this case, you will see in this regular table which trades were profitable and which were unprofitable. And you'll be able to find a trend quickly. That is, you do better on some time frame, you do better in some asset, you do better at some time of day. And by tracking these moments, you will be able to choose the ideal configuration for your strategy, and then use only this configuration in the subsequent trading. Here are 6 simple mistakes, frequent mistakes, and 6 simple solutions to those mistakes that I've talked you through in this video. Just try, literally from the next trading day, to use all these recommendations. And once you eliminate all 6 of these 6 literally childish rating errors, your results will improve markedly.